Hewlett Packard Enterprise just shocked the entire financial world by adding billions of dollars to its market cap in a single trading session. On June 1st, 2026, the enterprise computing giant reported blowout second quarter earnings that sent its shares soaring by over 35% to an all-time record high. This massive move represents the single largest daily gain in corporate history and has pushed the year-to-date return to nearly 100%. Investors are realizing that the massive wave of artificial intelligence spending is no longer limited to high-flying chip design companies or server startups. Legacy tech companies are securing their place in the new infrastructure build-out, and Hewlett Packard Enterprise is proving that it can translate this artificial intelligence hype into real, high-margin profits. We're going to break down the mechanics behind this historic rally, dissect the actual technology they sell, and evaluate how they stack up against major rivals in this high-stakes race. To understand this massive stock move, we have to look closely at the numbers from the quarter ending April 30th, 2026. The company reported record-breaking quarterly revenue of $10.7 billion, which comfortably beat Wall Street consensus expectations of $9.8 billion. Even more impressive was the profitability side of the equation. Non-GAAP earnings per share came in at 79 cents, crushing the analyst estimate of 53 cents. What really caught the market off guard was the revised full-year outlook. Hewlett Packard Enterprise raised its fiscal 2026 revenue growth guidance to between 29% and 33%, a massive jump from its previous forecast of 17 to 22%. The leadership team also revealed that the company is on track to hit its long-term 2028 financial targets 2 full years ahead of schedule. This rapid acceleration of growth is fueled by an unprecedented rush for data center hardware and specialized networking equipment. Over the last year, 4 big tech companies alone have committed to spending over $700 billion on artificial intelligence infrastructure. Hewlett Packard Enterprise is capturing a significant share of this capital. The total order backlog of the business has reached record heights as demand continues to significantly outpace actual revenue conversion. According to Chief Executive Officer Antonio Neri, enterprise customers are desperately trying to secure hardware supply to avoid being left behind. Another major driver behind the numbers is the completed integration of Juniper Networks. The company is extracting massive cost synergies and operational efficiency from this merger much faster than analysts previously modeled. This integration has helped push non-GAAP gross margins up to nearly 37%, which represents a massive increase of 750 basis points compared to the same period last year. On top of that, the company generated $900 million in positive free cash flow, representing a complete turnaround from the $900 million cash burn recorded in the prior annual second quarter. Analysts are quickly re-rating the stock, with major institutions like Wells Fargo and Citigroup raising their price targets to $70 per share as they realize the durable nature of this massive growth cycle. To understand why this company is so critical to the modern economy, we must examine what they actually build and sell. Hewlett Packard Enterprise does not design chips like NVIDIA, but they build the massive, complex systems that make those chips usable. Their primary business revolves around high-performance servers, hybrid cloud solutions, enterprise storage, and high-speed networking. When a large company or cloud provider wants to deploy artificial intelligence models, they don't simply plug a few graphics processing units into a wall. They require customized, liquid-cooled server racks that can house hundreds of processors, distribute power efficiently, and manage massive heat loads. Hewlett Packard Enterprise provides these fully integrated systems through its cloud and AI business segment. This segment alone brought in $7.7 billion this quarter, showing a massive increase of nearly 23% year over year. But the real secret weapon in their portfolio is high-speed networking. Training modern artificial intelligence models requires thousands of specialized chips to communicate with each other instantly. If the connection between these processors is slow, the entire system is bottlenecked, wasting millions of dollars in computing power. This is where the networking division of the enterprise, bolstered by the Juniper Networks acquisition, plays a monumental role. In the latest quarter, networking revenue jumped to $2.7 billion, representing a massive shift in the company's product mix. Their networking solutions allow enterprises to build high-performance data fabrics using advanced Ethernet protocols. On top of that, the market is shifting toward what is known as agentic artificial intelligence and artificial intelligence inference. These workloads are far more complex than simple chatbots because they involve software agents that can perform tasks, make decisions, and analyze unstructured data with minimal human intervention. Running these sophisticated agents requires massive private cloud infrastructures and highly secure storage systems. Hewlett Packard Enterprise is capturing this demand by offering full-stack solutions that combine server power, unstructured data storage, and integrated security. This enables enterprise clients to deploy private artificial intelligence factories directly within their own secure networks, protecting their proprietary data while harnessing cutting-edge machine learning capabilities. The landscape of enterprise hardware is a brutal battlefield, and Hewlett Packard Enterprise is fighting some incredibly tough competitors. Their most direct rival is Dell Technologies. Dell recently posted its own spectacular earnings, with revenue rising 88% to nearly $44 billion, driven by a massive $60 billion full-year outlook for artificial intelligence servers. While Dell has captured massive headlines through its close partnership with NVIDIA to build AI factories, Hewlett Packard Enterprise operates with a very different margin structure. Hewlett Packard Enterprise has achieved non-GAAP gross margins of nearly 37%, which is significantly higher than the historical margins of Dell that often hover in the low 20s. This is because Hewlett Packard Enterprise has a much higher mix of software-defined storage and high-speed networking, especially after integrating Juniper Networks. Another major competitor is Supermicro Computer, which has been a darling of the artificial intelligence rally. Supermicro is known for its extreme speed to market, often being the first to ship new server configurations containing the latest chips. However, Supermicro operates on incredibly thin margins, with its gross margin sitting around 10%. This thin margin profile leaves Supermicro highly vulnerable to component price hikes and supply chain disruptions. Hewlett Packard Enterprise, on the other hand, focuses on enterprise-grade reliability, comprehensive support services, and integrated networking, which allows them to command much higher pricing power and maintain healthier profit margins. When we look at the networking side of the business, the dominant player is Arista Networks, which specializes in high-speed Ethernet switches for hyperscale data centers. Arista reported first quarter revenue of $2.7 billion, showing 35% growth. While Arista is an elite player with gross margins exceeding 60%, they are highly dependent on a few massive hyperscale customers like Microsoft and Meta. Hewlett Packard Enterprise offers a much more diversified portfolio, serving tens of thousands of corporate enterprise clients, campus networks, and government agencies. By combining Juniper's industry-leading automated networking software with their own massive hardware distribution channels, Hewlett Packard Enterprise is actively challenging the dominance of Arista in the enterprise network fabric space. Now let us run the actual numbers to see if this massive stock rally is justified or if the market has gotten ahead of itself. Following this 35% surge, Hewlett Packard Enterprise is trading at a record high of around $64 per share, giving the company a market capitalization of approximately $62 billion. At these levels, the stock is trading at a trailing price-to-earnings multiple of roughly 44. While that multiple might look expensive compared to historical averages for legacy hardware companies, we have to look at the forward-looking earnings projections. The company recently raised its annual adjusted earnings per share outlook to a range of $3.35 to $3.45. If we calculate the forward price-to-earnings ratio using the midpoint of this new guidance, which is $3.40, the stock is actually trading at a forward multiple of just under 19. To put that into perspective, let us run a growth scenario. If the company manages to grow its adjusted earnings by a modest 15% annually over the next 3 years, their adjusted earnings per share would rise to approximately $5.17 by 2029. Applying a highly conservative multiple of 15 to those projected earnings would result in a stock price of around $78. This represents a solid 22% upside from current levels, even with multiple contraction. The market is beginning to realize that the stock was deeply mispriced when it was trading in the low 20s earlier this year. Investors were treating the company as a low-margin legacy server box maker, completely overlooking the high-margin networking and software services recurring revenue stream. The recent earnings beat represents a massive fundamental shift, proving that the company can generate strong, highly profitable free cash flow while riding the biggest technology tailwind of our generation. Despite the incredible optimism surrounding this earnings blowout, we must carefully consider the major risks that could derail this rally. The most immediate threat is the highly cyclical nature of enterprise hardware spending. The current rush to secure server capacity is partially driven by corporate fear of missing out and concerns over future component availability. If the broader economy slows down, or if the return on investment for artificial intelligence projects fails to materialize for enterprise clients, we could see a sudden and drastic pullback in capital expenditures. This would leave hardware suppliers with bloated inventories and a rapidly evaporating order backlog. Another critical concern is supply chain vulnerability. High-performance servers require specialized memory, cooling systems, and advanced graphics processing units that are often subject to severe shortages and price hikes. If component costs rise faster than Hewlett Packard Enterprise can raise its selling prices, their gross margins will face severe pressure. We also cannot ignore the intense competitive pressures from Dell and Supermicro, who are aggressively slashing prices to secure market share in the high-profile server deals. Finally, the integration of Juniper Networks, while currently ahead of schedule, still carries execution risks. Any disruption in combining these massive corporate structures, sales forces, and product lines could damage customer relationships and slow down the momentum of their high-margin networking division. Investors must weigh these potential headwinds against the current booming demand. In summary, Hewlett Packard Enterprise has successfully transitioned from a legacy infrastructure provider into a highly profitable frontline player in the artificial intelligence revolution. Their record-breaking second quarter results show that their strategic bet on high-margin networking, combined server solutions, and private cloud architectures is paying off handsomely. While the sudden 35% surge of the stock has eliminated the deep discount it once enjoyed, the forward valuation remains highly reasonable compared to many other high-flying technology names in this sector. Investors must balance the massive near-term tailwinds from enterprise artificial intelligence adoption against the longer-term risks of cyclical hardware downturns and intense competitive pressure. We will continue to track this fascinating story as the enterprise hardware war intensifies. If you want to stay updated on deep-dive financial analyses and the latest stock market trends, please subscribe to the channel and turn on notifications.